share our screen. That's probably what I did, is not hit that share button. And then the whole video that I was trying to show y'all, this thing was not. All right. So, last class, I found my spot. Okay. We went through the reading part for this next part with amortization. Honestly, though, I mean, we can go through that again, but I think that the best way for you to get this is by going through these problems, because I can explain it as we go. It's kind of hard to explain something you haven't seen, you know, without showing you. So, hang on a second, I'm trying to make sure I got everybody. Okay, so let's go ahead and just jump in some of these problems. All right, and I've got a recap here if you want to go back and refer to it of just different, what? So I say wait. I'm hearing things today. I think that's kind of a regular thing. I think sometimes I'm hearing people in the hall and I'm thinking it's y'all, or either y'all aren't admitting that you said something. Y'all playing with me. All right. So let's just kind of review a little bit with discounts. The reason that a company would sell their bonds at a discount is that the interest that they're going to pay on their bond is an interest rate lower than what they could go out and buy on the market. So they have to give them some sort of incentive to buy their bonds. And the whole purpose of the discounts and the premiums is so that at the end of the day, or the end of the bond period, that the bondholder has been paid market rate of interest. Now, it may not be in every interest check they get. They may get it on the front end, they may get it on the back end, but they're still going to get it at some point. So let's look at this first example. On the first day of the fiscal year, American Industries, Inc. issues a $600,000 3% 5-year bond. Okay, so here is your bond, face amount, interest rate, and duration. So all those things would be included in your bond indenture, which is what? What's a bond indenture? What's like a layman's word for bond indenture? Contract, agreement. That's their agreement. So when the corporation sells this particular bond to an investor, they're saying, we're going to pay you 3% interest, and it's semi-annual, so that's part of it too. 2 times a year, and at the end of 5 years, we're going to give you $600,000 back, or whatever increment they bought. The market rate of interest at the time this particular bond was issued was 5%, so it's higher. So they're going to have to sell their bond at a discount to get investors to buy the bonds. So the bond was sold for $566,874. All right, so the first thing we're going to do is journalize the bond issuance. So let's go ahead and do that. We've been doing that all along, so that should be pretty easy. We don't have a specific date. All right, we have issued or sold bonds, so we know we're going to have a debit to cash. How much is that going to be?
566,000.
Yes. Somebody last class was determined it was face amount, and she kept saying it. She was getting so frustrated with herself. Okay, so they're telling you the sales price. So that's what you're getting in cash, or the company's getting. All right, so we know we're going to have bonds payable because we've got an amount we've got to pay back at the end of this 5-year term.
Is it discounts on bond payable?
We will have that, yes. And I mean, you can go ahead and write that down if you want to. The reason I kind of do it in this order is to fill in the knowns, the things that are like obvious to me, so that if I'm confused about which way a discount goes, debit or credit, or if it's I'm sorry, making sure it's not one of my kids. Then I can tell once I get the knowns in there. So I know that I got cash of 566,874. What's my bonds payable amount going to be?
600,000.
The 600,000. Bonds payable will always be your face amount, regardless of what you sell it for. The company's always going to pay back this amount at maturity. They're always going to write interest checks for this interest rate divided by 2. But for the year, they'll pay out this interest rate. This is relevant for sales price, but as far as how much is going to get paid at maturity and how much interest, this is what's important right here. That's the contract. All right, so we've got cash. We know how much we got. Bonds payable, we're going to have to pay back 600,000. So we've got a difference in our entry. We got less than we're going to have to pay back, so we know we had to issue a discount. So how much is our discount?
33,000.
Yeah. Now, I mean, you can either figure that ahead of time by taking the difference between the two, or make your entry balance. Okay. What is it? You couldn't say it? Better? Okay, so the next thing to do is to record the journal entry for the first interest payment. Okay, and the amortization. So as part of our interest payment, we're going to take a piece of that discount every time we pay interest, and we're going to get rid of it a little bit of time. Remember, I was telling you that, yeah, these people are going to get a lower rate of interest with their interest checks twice a year, but at the end of the bond term, they're getting back $33,000 more than they paid for it. So that difference in that interest rate, they're going to get on the back end, right? Okay, so kind of like that whole matching thing where you're trying to get the right things in the right periods. I mean, essentially what that $33,126 represents is interest. So we're going to take a little piece of it out every time we make a check out to these bondholders, because really, since we're going to have to pay back more than we collected, it's really interest expense. We're just going to show it in the proper period. Does that make sense? I'll show you a little more in a minute. Okay, so let's calculate what the interest payment is supposed to be. And now we're calculating the payment. That's the amount of the check they're going to write for interest, okay? So we'll take the face value of the bonds. And remember, this is based on the contract or the indenture. All right, so $600,000 is our face amount. Our contract rate of interest is 3%. So 600,000 times 3%, that's going to give us the annual, the yearly amount. We're making it in 2 payments. We're splitting it in half. So that's why you're going to divide by 2. So this amount right here is 18,000. So half of that's going to be 9. So each payment, our cash is going to be credited for $9,000 twice a year for 5 years. Okay. So how much of the bond discount are we going to shave off every time we make an interest payment? How much was our discount? It was $33,126. Now, you're going to divide that by the total number of interest payments you're going to make during the life of this bond. How many is that going to be?
10.
2 a year times how many years? So it's for the whole life. So let's say entire life of bond. So in this one, you'll have 5 years times 2 payments per year. Y'all pay attention to this because I think in all of mine I have 5 years, 2 times a year. But I think you have homework problems that'll say something different, like 7 years, twice a year. So it'd be 14 instead of 10. So y'all pay attention to that, okay? Because that threw some people off. I got some questions from some online people that were like, I've tried with 10, it's not working. I was like, well, that's because it's a 7-year bond. So make sure you're using the life of the bond. How many years is it? And how many times is they pay interest a year? All right, so we'll divide this number here by 10 and just round it. No, that ain't right. It is 3313. Okay. So what that means is if every time we pay interest, we take off that much of the discount, then by the time the bond matures, it'll be gone. It'll zero out. We don't want it left there. Because if it's left there and we pay the bonds out, we got to get that discount off. It's related to those bonds. So what will we do with it? I mean, credit cash, debit bonds payable, and then you got this discount amount you got to do something with. Because you got to pay them $600,000. So anyway, you don't, if you pay them $600,000 and you take $600,000 out of bonds payable, you still got this discount stuck on there. You see what I'm saying? You got to do something with it. It's interest. So we'll just write it off a little bit at a time. All right, so now what we're going to do, we know the amount of our interest payment. We know the amount of our amortization. So we're going to combine the two and figure out what our expense amount is. So this is for your journal entry. So our interest payment is $9,000. And our amortization is $3,313. So our interest expense every time we pay interest is $12,313. Okay, I looked up a definition for amortization because I don't know. Textbook is always gives you such a technical, high-level definition that most of us are like, you just kind of go into a daze, glaze over. So what amortization means is a portion of a bond discount or premium transferred to interest expense over time. That makes more sense to me. So we're just moving it over every time we make an interest payment. All right, so what this is going to look like. Back to the page. We are going to, and this is your first interest payment. I think it's any dates. Nope. You're going to debit interest expense. You're going to have to credit cash. You're going to credit cash for the amount that you agreed to pay them, which is $9,000. Okay. Interest expense is $12,313. So we've got to credit discount on bonds payable every time we make a payment. So what this is doing is this is creating on the books interest expense that matches market rate. Because we sold it to them, we took a hit on the sales price, and it was because of the interest difference. So if we just take a little bit off every time we pay them, then our interest expense on our income statement is going to be market rate. Does that make sense? That's the whole point of the premiums and discounts, is to get everybody at close to market rate. So we're just making our books reflect market rate. That makes sense? Okay. So you have, you work this one. So y'all do that real quick. Let me show you the answer. That would be cheating. Y'all work the next one. See how you do. When you want it done, kind of look up at me and let me know you're finished. I want to make sure you kind of. The homework? All you were doing was journalizing bond issues, wasn't it? You all right? Yeah, Muscle grants? Oh, I hate that. I get them in my hands and I get them under here, get everywhere. What do you do for it?
It's not. It's not. It's like a tip.
Oh, that's worse. Then you can't make it stop. I'm sure stress gets it up too. Sometimes, man. Well, it just makes you more interesting. I'm sure you don't feel like it. All right, so.
Do you know what cash they gave us was higher than the base value? It would be premium.
That's right.
Bonds.
Mhm.
Okay. I'm just making sure.
We'll do this next.
Yeah, I was doing the homework last night and I was journalizing them and then it counted me wrong because I put bonds payable after cash and then I put discounts on bonds payable
We
after
can
that.
have it.
Yeah.
So it didn't give you full credit,
I did it right, but it's just I put them in like a weird order.
so it cut off some of your credit.
Yes.
Did you fix it?
Mhm.
So you know what was wrong.
Because yeah, I was so
So I'll try to remind y'all that it does that because it's not fair to me for you to get it right and then lose credit because it doesn't want to.
I was confused at first because I was like, wait, I was like, I know my math is right and everything.
Mm-hmm.
I was like, oh, it's a weird order.
Mm-hmm. Don't go so far. I'll agree with them. Can you see it? You need any of the rest of it? Everybody get that? Can I go back up? This way? You what? You did get it right. Okay. Who did? You understand why? You don't? You didn't get what?
Oh, I need 10 instead of 2. That's fine.
You're just adding, on step 3, you're adding your interest check, what you're paying them, plus the piece of the discount that you're writing off. That'll be your expense amount. This is the thing. Think about it like this. I guess I should put this.
Oh.
I think we're going to put this. All right, so think about it like this.
I have the line number.
Okay, I got you. So when you sell this bond, and it has a discount on it when you sell it. So your debit and discount for $364,701. Oops, think of it. If you don't take out a little bit of it each time so that it shows expense, then when you pay those bonds completely out, you're going to have this big chunk of interest that really, it belongs spread out through the whole bond life, you know, the whole duration, the whole term of the bond. Because essentially, like I said, you're selling it at a lower price, and then you're giving them more money on the back end when you pay it out. So they're getting their difference in interest. But because it relates to the entire bond issue and the entire term of the bond, you want to piece it out. Does that make sense? Y'all good? You just did something wrong with the number? Okay. Y'all good?
Yeah.
All right. So let's look at the flip side with the premium. It's going to be a little bit different. I'll erase this. Okay. That doesn't matter. All right. So let's look at it with the premium. On the first day of a fiscal year, Saxon Industries issues a $5.5 million, 7% 5-year bond, semi-annual interest. Bond was sold for $5,764,699. So just looking at it, because your homework, your test questions aren't going to say amortizing a bond premium. You're going to have to know that. But if you're getting more money than the face amount, then obviously you have a premium. So we're going to first calculate, journalize the bond issuance. So what that'll look like, what are we going to debit cash for? How much cash did we get?
$5,764,699.
All right, that's the amount of cash we got. What are we going to have to pay back at the end? What's the face amount?
$5,500,000.
And that's what you'll always put in bonds payable. It's always going to be the face amount. So you got this difference. You know you got more money than you did, than you have to pay back. So you know you got a premium on bonds payable. Okay. So there's the bond issuance. Okay, so let's go back and figure out our interest. All right, our interest payment. How much we're going to pay the bondholder twice a year. Check they'll get, deposit in their account, whatever. You'll take the face amount of the bonds and multiply it by 7%. I can't talk. This right here is $385,000 a year. That's what that comes out to. You'll divide it by 2 because there's 2 payments. So it's $192,500. That's your interest payment. All right, our bond premium was $264,699 in our entry. We got to divide that by the total number of interest payments. We got 5 years. 5 years times 2 payments per year. That's 10 years. All right, so we'll divide that by 10. And the $26,470 is the amount that we'll take off every time we make an interest payment. So in this case, we're not adding it to the interest payment to get expense, we're subtracting it. Because our interest rate, we sold it at a premium because our interest rate that we're paying is higher than market. So the customer, the investor had to pay us more than face amount. So our interest expense, if we're gonna make it, you know, look like market rate, we're gonna have to reduce what we're paying now. Does that make sense? So it's the flip side, it's the opposite way. So we'll reduce our interest payment to calculate expense. Now our payment's not gonna change, so I don't mean to be confusing. This is our interest expense amount right here. We're still gonna pay the $192.5. But when we sold it to them, we had them to pay extra up front so we could recoup that difference. All right, so interest expense. We're gonna debit our interest expense. We'll have to debit our premium on bonds payable because when we recorded the issuance of the bond, we credited premium. So premium's got a credit balance. If we're going to take some out of it, we got to go the other direction. And then we'll credit cash. All right, well, we calculated our interest payment. It's $192.5. All right, so our premium, we divided that by 10. We're going to take $26,470 out of that account every time we cut an interest check. And then we calculated our interest expense. But do y'all see how we got to pay them whatever's on the contract, regardless if it's higher or lower than market rate. So we're going to have to pay them the higher amount. The interest expense, we're taking it down so that our books don't reflect a higher interest expense than that it should. I mean, we charged them more to even it up. Everybody good? Does that make sense? You sure? All right. Y'all do this one. See how you come out. Does that help y'all to do your own? Yes?
Yeah.
I don't want y'all to get out here and go into do homework and have absolutely no clue what you're looking at. You may feel like that anyway, but at least I'm trying. Did y'all get that? Anybody need to see the top part? You good? Okay. All right. The next thing we're going to look at is redemption of bonds. Redemption of bonds is paying them out before they are due. So a corporation may redeem or call bonds before they mature. So that's their terminology, redeem or call. So they'll do this a lot of times when the market rate drops and it drops below what they're paying in interest. So they may want to do that to keep from paying a higher rate than they have to. So what they might do is issue a whole new set of bonds at a lower interest rate than match market, and then take that money they get from selling those and pay out the higher interest bonds. So callable bonds, if you buy a callable bond, it's in your bond indenture, the contract. What the time period, you know, like the range of time they can do that, and what price they can, if they want to call them, the price that they have to pay you for them. So all that's set up when you buy the bond. And normally that call price is above face value. They can also, a corporation can also, if they want to, you know, pull their bonds back in, they can go out on the open market and buy them. Now, they're usually going to pay a different price than what they sold them for, especially if they're trying to pull them back in because the rates have gone up. Or down, rather. So they're going to usually redeem them for a price different from the carrying amount. So when they do that, there will be a gain or a loss on redemption. So if the gain, if they have a gain, it's because the price they paid the bondholder for the bond is less than what the bond carrying amount is. And the reverse for loss. If you have a gain or loss on redemption of bonds and you're doing the financial statements, I think really all we covered was like revenue, expenses, net income. Well, it would be revenues, expenses, net income, other income or expense. It's another section that falls below there. So that's where that would go. Just know that for multiple choice purposes. So the carrying value or carrying amount, book value of bonds. So what that looks like, what that looks like, trying to see where I have enough room to write that. I'll write it down there. Before I do that, here's some, kind of a summary or recap of some of that information. One thing to note for your homework, if you see in the problem, a bond was issued at 96 or it was redeemed at 102, that's a percent of face. So to figure out how much cash is in, how much cash came in or went out, multiply whatever number they're giving you, 96, 102, whatever it is, times the face amount, and that'll tell you what the cash, what the proceeds were, okay? So, all right, carrying value. Or book value. How you calculate that? If you have a discount, let me think about this, make sure I get it right. With a bond discount, you will take the bond's payable amount and you will add, you subtract, sorry. You subtract the discount. That will give you carrying value or book value. All right, if you have a premium, it will be bonds payable. So whatever your face amount is, plus the premium. And when I say discount or premium, I mean unamortized, whatever's left on the book. So I'll put, because if you've had the bond issued for a while, you've been chipping away at that discount or that premium. So you're looking for what's on the books. So you're looking for the balance in these accounts. That's going to give you carrying value or book value. Same thing. Book value and carrying value is the same thing. It's just a different type. So your bonds payable is going to be the face amount. Your discount premium is going to change every time you make an interest payment. So whatever the balance is, that's the same thing as unamortized. It's what's left. Does that make sense to y'all? No, you're not totally confused. If y'all don't understand something or I'm not making sense, y'all stop me. Or is that just kind of a normal process? That y'all don't understand what I'm talking about. All right, bond redemption. Example 1. We've got a $350,000 bond issue. So this right here is your face amount. Or what's in bonds payable. There's unamortized discount of 15, so that's what's still in your discounted bonds payable account. So this is the balance, not right, legibly. Balance in discount on bonds payable on books. And they're going to redeem these bonds for $340,000. So this is the payment to bondholders. So they're essentially paying them out early. They're going to pay these bondholders $340,000. They've still got some discount on the books, $15,000, and the original bond issue was for $350,000. So we got to figure out. We can do it one of two ways. We can just journalize it and figure out. Let's do that. All right. So again, like what I tell you before, put down your knowns. So how much do we have for bonds payable?
350,000.
It's $350. That's the amount of the face. Ooh, sorry. Dang, I don't even think I touched it. Huh? $350. It's telling you a $350,000 bond issue. That's your face. I mean, you almost have to learn to interpret the wording on these things and pick them apart. All right, so we know we've got bonds payable. We got to get off the books, $350. All right, we know at some point we're going to have to credit cash. I'm putting it at the bottom because it's engaged and the debits first and the credits last. So we have been told that they're redeemed for $340. So our cash credit is $340. Okay, so now we got this other stuff. All right. When you make an entry to record a bond issue and you have a discount, what's the normal balance of discount? Is it a debit or a credit? Do you remember?
It's a credit.
It's a debit.
Oh,
Let's look. All right, so this is the thing. When you have your test, you're going to have a progression of, usually I do the problems in the order that we kind of learned them, right? So if you have to, go back and look at one of your entries where you journalized a bond issue. Okay, nope, that's premium. So think about it. We got less cash than we're going to have to pay back. So our discount's a debit. It's got a normal debit balance. Okay. All right, so if our discount has a normal debit balance and we're going to get rid of it, we've got to credit discount, right? $15,000. So what do I need to make my entry balance? I need a debit or a credit, how much? What are my total debits right now?
350,000.
Yes. What are my total credits?
355,000.
So what do I need?
A $5,000 debit.
Thank you. Gotta put a $5,000 debit in here to make our debits equal our credits, okay? So when you have, what's the normal balance of a revenue account, of an income account? Do y'all remember? It's credit. So if we were adding to revenue, we'd be doing a credit. But this is a debit. So it's not income, it's a loss. But I'm going to show y'all how we can prove that. So we're going to say loss on bond redemption or redemption of bonds, or either one's fine. Just copy and paste your labels and Cengage. Okay, so to figure out the carrying value of this bond, we have our bonds payable amount, and we're going to subtract that discount. I gave y'all that formula a minute ago. So our carrying amount is, looks like a Z, 335. That's our carrying amount, carrying value, whatever. All right, so if we take that carrying value, this is not part of the entry, so I don't know what it looks like. All right, so let's take the carrying value and subtract out what we're having to pay. So we've got 5,000 negative, because think of the carrying value as this. This is what I owe. This is what the corporation owes for these bonds at that point. So if this is what they owe, and this is what they paid out more than they owed. So they came out on the losing side of that. Does that make sense? I can't tell. All I can see is eyes. Are you you talking? You are. I know that
Me?
voice. No, I'm just looking for you. He got that deep voice. What are you saying? I'm gonna make you come up here and tell everybody. All right, so this is a loss because they paid out more than they owed. So does that make sense? So think of it like this. A gain will be a credit because it's income. It's increasing your bottom line. It's a good thing. The loss is a debit, kind of like an expense. So it would be bringing everything down. But I mean, there again, if you just have to remember that losses are debits and gains are credits, you know, it's kind of like solving a puzzle and you're putting all the pieces in there. All right, let's look at one that has a premium. So this one is a $1,350,000 bond issue, and there is an unamortized premium of $50,900. So on the books, they've got bonds payable, $1,350,000, and they've got premium on bonds payable, $50,900, which is also a credit. So they're going to redeem them for $1,390,000. So this is the cash payout. This is bonds payable, and this is your premium balance. So if y'all want to, we can look at see if we got a gain or a loss before you start. All right, so your carrying value, when you have a premium, you take bonds payable and you add it to it. So we're going to take our, I need to touch the thing, I swear, $1,600,000, and we're going to add the premium amount. So our carrying value is $168,432. Now I'm missing a zero. Hang on.
I thought we was on 2.
Yeah, we are. We're on
Yeah,
2.
where'd you get that?
Oh, am I picking up the stuff, y'all? I swear. I'm sorry. Start over. Back up. All right. Sorry. Let's see. All right. I'm still going to put it under here. I just need to use the right numbers. All right. Carrying value. Start this again. Bonds payable actually $1,350,000. And you're going to add the premium. So our carrying value is $1,400,900. I don't have my answer for this one. I don't know why. Did y'all get that? Yay, nay. Yeah. You don't trust me. Don't trust my math.
Yeah, that's right.
That's right.
I can do accounting. It sounds crazy. I can do accounting, but math in my head is not my gift. You give me a 10 key. Y'all know what a 10 key is. One of those calculators that has a tape on it. I mean, I can short them out. I can go so fast on those things, I'll short it out. In my head, not so much. It shorts out my head. Just shorts out my brain. All right, so we'll take that carrying value and we'll subtract out what they had to pay to redeem the bonds, and we come out with a positive number. So 9,100, is that right? Yeah. I could tell y'all anything and you would
I
believe
thought
me.
it was, shouldn't it be like 10,900?
All right.
Yeah, 10,900.
Is it 10,900?
Yeah.
Yes. Okay. I told you not to trust me. Okay, so if you're coming out with, this is what you owe. And this is what you're paying. Then you came out on the better end of that deal, right? You're paying less than you owe?
Yeah.
It's a game. That's a good thing. All right. So that'll help you with that piece of it. And remember, gain is like income, so it'll be a credit. All right, so we're always gonna have to debit bonds payable for the face amount, which is not 1,000,006, but 1,350,000 for this problem. All right, we'll have to debit our premium on bonds payable because it has a credit balance and we gotta get rid of it. So we're gonna do the opposite. All right, and then we know we have a gain, so that'll be a credit. You can say bond redemption or redemption of bonds, whatever. It'll probably be redemption of bonds if I had to guess, and disengage, but again, you can copy and paste that. So your gain will be a credit, and then we'll have the cash credit of 1,390,000. Now, if you're doing them by hand, check your math. Your debits should equal your credits. So this total should equal that total. So plus, plus, minus, minus, you should come out with 0, right? Am I good? Y'all have younger minds. Y'all don't have as much crammed up in theirs. And then y'all go on spring break and you'll hit that flush, hit that lever, and it's all gone. All right, y'all did this next one. Yes.
Now we get the 1,600,000.
Oh yeah, I know. Sorry about that. I get ahead of myself. I start picking up stuff I shouldn't be picking up.
I know, we got out of like,
I know. I was like, what's happening? I don't understand.
yeah, we got out like 45 minutes early. I was like, what?
Well, yeah, it's like 20 minutes.
Never let us.
Are y'all reviewing something for the test?
Well, no, it's because today we were finishing up chapter 7. And I think, I don't know if my class was ahead or what, but like we finished it up pretty early in the class, so we just let's go.
Y'all get it? No? Or yeah?
Wait, I'm almost done. All my numbers are all right.
Okay, well then go on and work example number 4. It's an easy one. It's an easy one. You should. You don't have premiums or discounts, so it should be pretty easy. Now I might not be able to go backwards. what now? I'm sorry.
There's no discount, no rate, how do you calculate interest expense?
It's flat out. It's the same as the payment. See, that's the thing, I almost made it too easy. Your interest expense is gonna be the same thing as your payment, because there's no premium or discount.
So it's the face amount.
Times your interest rate divided by 2.
So does it matter if it's doesn't say if it's $78 million?
Does it not say?
No, it doesn't say $78 million.
Then assume it is.
Okay.
Yeah, well, it does too, because it's telling you that the interest is payable on May 1st and November 1st, so that's 2 times a year. So it's just because it doesn't say semi, that I'm throwing stuff in there so y'all can see it, like interpret it, if the same exact language isn't used.
She said, "Shut up."
What are you saying? What are you talking about?
Now, you know, I had a teacher today tell me I was right and she was wrong. You know how good that is?
Really? See, I tell y'all that kind of stuff all the time. I ain't too proud. I know my limitations. I'm not perfect. Did y'all get that? Why? Was it too easy?
I got the second one, but that third one, I had to leave that one to God.
Well, it's because it's too easy. So you take out that, extra piece of complication in it. No, it was still complication. No, that was easy. That was an easy version. Okay, well,
Wait, this lesson?
what you want? You hungry?
Yes.
I told you you could bring snacks in here. It's not even here. Why is that even still in there?
I gotta go to the train.
Is that 96%?
Mm-hmm.
So how did you know it's
Well, because the bonds payable amount's always gonna be face, so it's $10 million, $10 million, but they're only having to pay $960. So they're coming out on the other end of the deal. Plus, you gotta plug the entry and a gain as credit, so. What only way we're looking at.
Yes, not that time.
Hey, did I say you could leave? I got you for 10 more minutes. Everybody can leave but Greg. You can go. Y'all have a good one.